and we're going to go through a presentation that Chuck brought to us a little while ago. And what we're going to talk about is here, what strategies are you trading in this current market? It has been a tough year. At one point, we were down about 25% from the high on January 4th or January 5th. We're still down about 19.8% from the high. There have been ups and downs, false signals, strange bears, a disgusting mid-June there that really hurt a lot of positions. During the course of this 7-month period, most of us have had to trade and switch tactics from what we were doing. What worked in 2020, 2021 was not really working anymore. You have to change strategies, change the structure, go with the flow for a little bit to try to get into your target ranges of what you wanted to see with what the market conditions were offering us. Now, we covered our thoughts in May and June, but we've covered our thoughts, of course, all through 2022. But we had a review in May, and then we did another one in June, the halfway point. Over the past several months, what we've done with strategy discussions, strategies we used, and other ideas from different markets. There are 2 videos that go through this on YouTube and on PowerOptions. One is Thoughts Halfway Through 2022. And for May 26th, May 27th, there's a presentation, Strategies in the Current Market. And as you can see here at the beginning of the year, we were talking about managing married put positions that were open as part of the radioactive trading technique. We started to discuss bear put spread ideas. Ernie was buying puts, and then when he got a profit on them, he would roll them down and convert it to a bear put debit spread for extremely low risk in those positions. We reviewed calendar puts using bearish calendar put structures, with the long put mostly out to April or out to May. And we discussed our ideas of using a 3 to maybe 4 month, maybe even smaller, maybe a 2 to 3 month out long strangle on broad market ETFs. So buying an out of the money call and buying an out of the money put, and then rebracketing the position when one side hit a certain profit target or you thought the market was going to turn. In February, we started to see the market climb back up after that January, and I got froggy and went back to my bread and butter, the bull put credit spreads that we've discussed over the years. I opened 7 bull puts in a 20-day time period, and I had to manage 3 of them. 2 of the 3 were managed into a bearish position for a profit using a pendulum adjustment. 1 of them took a small loss. But I got out at the perfect time because the market started to fall again. And we saw SPY cross its 20-day moving average there in mid-March. We were looking at standard collar positions for protection with an uncertain market. We're managing the married puts that we still hold, and we're adjusting those strangle positions going forward. That would have been a good time over that next 15 to 20-day time period to maybe do bull puts or bull call debits as well, or start a longer-term maybe calendar spread, but it didn't turn out that well. But that 10, 15-day period would have been ideal for those strategies. And as you can see, I personally was a little bit gun shy. Then we started to see the decline in April, and we talked about income methods on the married puts, the radioactive profit machines, rebracketing or closing the standard collar positions, or maybe doing bearish collars at that time, still owning stock, but creating a bearish position with a collar structure. And this would have been an opportunity to do bear put debit spreads, but I sort of missed that opportunity personally. And as we entered into the earnings season, we started some new ideas on looking at which ETFs were strong with positive earnings in a sector and which ones were weak, and buying calls or puts on the ETFs that didn't have as much volatility as the individual stocks, where you'd need a bigger move because you were buying into an earnings play, but the ETFs were not as volatile, so you still didn't get an overinflated price. The community focus. Early in the year, we had discussions on bear put debit spreads, as I mentioned. Also, out of the money bear calls or 30 to 60 day out bear put debit spreads. We talked about the calendar puts, looking 5 to 6 months out to buy a put before the implied volatility spiked, and then selling shorter term as a bearish spread position, similar to a bear put debit, just 2 different expirations. And we talked about the management of existing positions, how to manage rolling covered calls or naked puts that were going against you. We had several webinars on that in January and February, discussing maybe adding puts to covered call plays or further out naked cash secured puts to create the calendar put spread as a form of protection, as opposed to just trusting the cash secured naked put structure, which has that bottom, as does the covered call, where stop orders are assumed insurance. They're not guaranteed. And then the other ideas, again, those 3-month strangles, 2-month strangles on broad ETFs, buying shares of volatility ETFs or calls on the VIX when the VIX was low enough as market hedges for the broader portion of the portfolio. Buying small calls or puts on sector ETFs during earnings, calls on oil and gas, puts on the retail XRT, which worked pretty well. This is copied from the other webinars, and then of course married puts to avoid market volatility following the rules in the blueprint, and of course the standard collars, which is great for level 1 or level 2 trading since you can't do bearish spread positions, but you can create bearish collars and you can have protection on your core holdings that's guaranteed, unlike a stop order. Why are we reviewing this again? Well, Chuck sent us a comment a couple weeks ago. We were off last week, but Chuck said, I would be interested in hearing from other PowerOpt users as to what is working for them. I realize that some will provide way too much detail, but if you like the idea, you could weed through them and pick 1 week at a time to talk about. Now, for those of us here, let's launch a quick poll. It's actually 3 polls, and we're only going to leave them open for a minute. But I'm kind of curious here about a few things to help us, and then we're going to get into further discussion from Chuck and from other PowerOptions users over the past several days. What I want to know now is, how have you been doing in 2022? Are you on par with your trading goals? Are you profitable but behind your targets? Are you at break even, maybe a little bit above or maybe a little bit below? Are you down in 2022, or do you feel 2022 has just been a complete dumpster fire in your portfolio and for your options trades? I'm going to be honest, I am number 2. I'm between 2 and 3. I am profitable. I am behind my targets. I would consider myself above break even, but not hitting my targets at this point. So now we've had the poll open for about 50 seconds. About 50% of you had voted. I'm going to leave it open for another 20 to 30 seconds or so. All right. So we've got 73% of our votes in, and let's just go ahead and close the poll. And I kind of expected this. I was hoping for a little bit better, but I was kind of expecting this. I think most of you kind of expected what we're going to see here. Let's go ahead and share the results. 9% said they are on par with their trading goals. Fantastic. 9% are profitable, but you're behind your targets for the year so far, the first 7-month cycle. I'm kind of in between these two. 9% are at break even. 64% are down in 2022, but thankfully not to the point where you feel it's a dumpster fire. Only 9% say that currently 2022 is a dumpster fire. All right, so that's good, but let's go ahead and follow that up very quickly. And I'm just curious here. This is a quick one. We won't leave it open that much longer, but what has been your overall sentiment approach for your trades? Have you still been trading bullish positions mostly in 2022? Have you been trading bearish positions mostly in 2022? Have you been trading neutral positions? By that, I mean maybe some kind of delta neutral, iron condor positions, trying to go far out of the money on both sides, bull and bear, maybe short strangles, deep out of the money in that case, hoping that you don't see too much movement in one direction or the other. Or are you a mixed bag? Are you going with the flow for adjustments on core positions or looking for new strategies? I'm the mixed bag, I think, and you can kind of tell that because normally my portfolio would consist of a certain percentage of trades. We'll talk about that in a little bit, but I've had to shift the percentages from bull put credit spreads, for example, into more calendar puts and bear put debit spreads with the market conditions. I haven't been doing as many calendar call spreads, of course. I've been doing more, investing more into those sort of out of the money strangles, which I wouldn't really call a neutral position. Buying a strangle, I do want movement. I'm expecting volatility one direction and the other. So it's not neutral. It's going with a volatile strategy where I'm expecting movement, just don't know which direction. All right, well, this is pretty good. Let's go ahead and close that and share it. 18% are trading mostly bullish positions. Maybe you're sticking with covered calls, going deeper in the money, deeper out of the money naked put positions. Maybe you're doing bull call debit spreads or poor man's covered calls or calendar spreads. 36% are trading neutral positions, whether that's the delta neutral, the iron condors, maybe short strangles, and 45%, other than the married puts I'm still doing with 40 to 50% of my portfolio, which would be bullish positions, are mixed bag, going with the flow, looking for new ideas as the market changes on a whim, it seems sometimes, with new news that comes out. But let's delve into that one just a little bit deeper. One last poll, I promise, and then we'll move on. What strategies are you using? And I don't have a lot of, I only had 5 choices I could enter, but are you doing still covered calls and naked puts? Are you doing credit spreads or debit spreads, whether bullish or bearish? Are you buying calls or buying puts with the market movements, or maybe doing straddles or strangles? And that's some of what I'm doing right now. Are you doing calendar spreads or horizontal positions? Poor man's covered call, diagonals, maybe double diagonals, which would count as a neutral. Or are you using protected strategies? Married put positions, collars, standard collars, maybe bearish collars that we've talked about before, or maybe even you have some kind of delta hedge that you're using on positions or on your spreads as well that you consider protected. So we don't know the specifics, I'm just curious here. All right, well, we've had this poll open for almost a minute. About 70% have voted. Well, it's pretty interesting. I don't know if I let you answer more than one here. I think it was only one, so I'm looking for whichever one you're doing the most of, and that's fine. Let's go ahead and take a look here. Let's close. Let's share the results. 30% are doing covered calls and naked put positions. 30% are doing credit spreads and debit spreads. And the last poll, no one really said they were doing bearish positions, so I'm assuming a lot of that is still bull call debits and bull put credit spreads, perhaps. No one is really relying on call buying or put buying or straddles or strangles. Well, it's a portion of my portfolio, but it's not the main part. There's out of the money strangles and the broad-based ETFs I mentioned. 10% are doing calendar spreads and horizontals. 30% are doing protected positions. I usually refer to that as the married put structure, the collar position, maybe even a bearish collar, for example. But you might be considering that as a protected position if you've got some kind of ratio hedge on your stock holding or just a ratio position as well. So that gives us some good ideas of what we're doing here. Now let's follow up with where we want to go. Chuck's approach, and I don't have the full details of everything here, 99% of Chuck's trades are credit spreads. He tries to keep delta neutral using bear calls and bull puts, considering a positive delta and a negative delta depending on the structure of the trade, bullish and bearish. On days when the market rallies, which we saw today, he tends to put on bear calls, and I put on bull puts when the market has dipped. I use various tools, including PowerOptions, to select stocks that I think are going up and down. I then put on spreads around the 10 delta mark. In theory, this is equal to about a 90% probability above for a bull put credit spread or a 90% probability below for a bear call credit spread. By applying a bias coming from some fairly sophisticated tools, my probability of not losing is closer to 96%. The goal is 1% profit per day on average, so about 5% per week. And so far, he says, I'm achieving that in spite of the various market gyrations. So that's a tough gambit. And I tried to do the bull puts there in February, and I still had to manage 3 of them, but only one really did lose. So some trades one might see. What I did quickly here on the PowerOptions tools, without knowing the other sophisticated tools that Chuck mentioned that he's using for stock direction or stock signals, I should say bullish or bearish, is we just created a simple bear call credit spread search, looking between 2 to 8 days out in time. So for next week's expiration, July 22nd. Percent return greater than 5, assuming we held the position all the way to expiration. I always like to put in an option bid greater than 1 cent, because a lot of positions that are deep out of the money might have a bid of 0 and an ask of $4. You might see a $2 midpoint, but there's no way you're getting that. So to clear out those, it's just easier to use that feature, even with volume and open interest. Short option delta less than 12. I could have put in less than 10, but I kept less than 12 to allow some other ones that were just on the border there. And the probability also of greater than 90. I also wanted to limit the bid-ask spread to be less than 50% between the bid and the ask. And the reason why is that a wide bid-ask spread, there's no guarantee that you're going to get the best price for it. You can hope for the midpoint, but it's less likely to be filled at that midpoint price. And then one thing that's important, I didn't put any technicals in. As Chuck said, he was using other tools to do that, but I did avoid earnings between now and expiration, which is extraordinarily important as we're entering earnings season for any credit spread or debit spread. And I decided to exclude indexes and ETFs because Chuck had mentioned that he was looking mostly at stocks. This isn't a recommendation of a search to use. This is just a real quick view of how you can set up a structure or how you can set up criteria to identify those positions. And what did we get? Well, Pinterest was one of the big movements today. Why was I using bear calls? Well, Chuck said when he sees the market rally, he might look to open bear calls. So that's why we ran the search. This one had a big move up today because of that recent stake that was purchased, a 9% or 12% stake by an investor whose name I forgot. But here's a 4-cent net credit on a 50-cent strike difference. That's one thing I wish I would have done was change the strike difference to be at least greater than 1 point or greater than 2 points to avoid those. But you see some common positions here. JD.com, stocks at 59.98, selling the July 22.67 call and buying the 67.50. It's a net credit. Oh, that's another 50-cent one. I'm sorry. There's a dollar. There's a dollar. I'm sorry. I saw the top one is pretty good here. And there it goes. I like this one, Lululemon. The 310, 312.50 with Lululemon at 286 is a bear call. It's not a recommendation or suggestion, but it's a 16-cent net credit on a 2.5-point spread or a 6.6% return, matching the potential goals of at least looking for 5% or trying to take 1% per day with the structure. That's what Chuck's doing. Now, I had mentioned this a week ago, this question that 2 weeks ago, sorry, this Chuck had come in, but unfortunately I've been out of town. Victor sent me an email, Chuck, and you can answer this anytime. No rush. We can follow up on it later. But Victor asked me, I'm curious at what point he closes a bad trade for a loss. Is it based on delta of 20 to 25? A change in the probability, which would equate to the change in the delta. Range out of the money. You started a certain range out of the money with the delta you wanted, but now instead of being only being 4% out of the money, you're now only 2 or 3% out of the money. Technicals and market shift, what it seems like Chuck was leading to based on what he was looking for. The other concept could be there, Victor, and I don't want to speak for Chuck, but the other concept could be, remember, his goals were 1% per day or 5% per week. If he's gone in the trade 2 days and he can close the position out for a total of 2% or 2.5% of his margin, he might take that because he's achieved his goals for that particular time period. But Chuck will follow up with me later, and I'll share that with everyone else once we get to that point. We wouldn't want to break down the entire structure, but it is important to note that anytime you're talking about going into a strategy, there's no one strategy, especially in these volatile markets, which is just put on the trade and walk away. You always have to practice proper position sizing, and you always have to have an exit strategy and management techniques in place for when those triggers are hit. Now, about a month ago, we had a similar approach to what Don was using. This is a video called Analyzing Deep Out of the Money Bull Puts for SPX. Don was only interested in trading bull put credit spreads on SPX, looking for about a 1 to 1.5% return every 30 to 45 days. But rather than look at delta or probability, Don wanted to force to go 20% out of the money. Now, on June 10th, during that presentation, the spread that we found that was 20% out of the money, it was about roughly 35 days out in time that expired today, was selling the 31.25 put and buying the 3100. It was a net credit of 35 cents, but because at that time only the 25-point strike differences existed for this expiration, it was a large margin of I almost said large margin there, a large margin of 24.65 to only get 35 cents in net credit, which is only a 1.4% return for 30 days. But it would have expired worthless. And if that's his goals, I don't like the margin to profit ratio in this case, but it would have met his goals. Chuck is more looking for 1% per day or 5% per week. With Don's approach and his risk tolerance level, this is a structure that he wanted to be 1, maybe 2% every 30 days or so with deep protection. Since we'd all had fallen 12, 15, or 20%, he didn't expect another 20% decrease. So he was looking at that range while volatility was high. And that's an approach that Don was using that we discussed a little while ago. Earlier, we had mentioned that we reviewed some of what we were doing in the discussions we had on that May 25th, May 27th discussion, strategies in the current market. And in that presentation during that week, I had a customer call on Wednesday, May 25th. He had been happy with using the monthly naked puts, the picks of the day on PowerOptions for monthly naked puts, and I thought that was odd. in that market. Yes, it had a little rally after the January decline, came back up in February, a little pullback there, and then it started to move back up. But then I did a back test from December 23rd to May 21st. It started off with $100,000, allocated 25% to the first 4 trades that came up on the default screen and used a 10% stop. And in the first 5 months, it was a 5.1% return, hitting that average Don mentioned, about 1 to 1.5% or so every 30 days using the naked puts and covered calls at a 70% win ratio, 14 wins and 6 losses. 4 of the losses came on the cycle of April 22nd to May expiration. All were closed out on April 25th on a big down move due to the triggers. At April expiration, before that big move, there were 14 wins and 2 losses, and the account had moved up from $100,000 to $109,000. So in the first 4 months was actually about a 9% return before a lot of that, half of that was given back with the April 22nd to April 25th decline that hit the market. So I decided to go back as well. And this is nothing great, but still profitable. Just doing the monthly covered call picks of the day, per Ernie's discussion, the criteria he used and setting the stops that he uses for those structures. December 23rd. Why December 23rd? That was the Monday following the last standard expiration in December, going to January 2022 expiration. Take an account with $100,000, allocate 33% to the top 3 trades that come up on the default search. Ending amount's $104,655, a 4.7% gain, with the market being down 19.8%. That's not too bad for a covered call structure to still be successful, with the market as a whole being down 19% from where it was. 21 total trades. These are only monthlies now, with 3 a month. 16 winners, 5 losses, so 76% win rate. The average return on your winners was 4.7%. The average loss was 12%. Per the structure and the stops that Ernie used. The monthly naked put picks of the day, not as good, but similar. In this testing, Ernie only did the top 2 trades, allocating 50% of the $100,000, same time period. Ending amount would be $103,663 or 3.7%. 14 total trades, because we're only doing 2 per month. 20 winners, 4 losses, 71% success ratio. Average return on the winners is 3.8. And average loss is minus 7.9. And again, why the change? Why was it doing 1% per month through May and then declined? Well, that's because in addition to what we talked about, the April 25th fall that hurt that other one, that big decline that we saw in mid-June hurt the structure where losses were taken and then some profits were made back during this neutral-ish period, going from about the 28th of June to July. Sort of stayed in this range of 370 to 385 roughly. So the out-of-the-money naked puts, the in-the-money covered calls still had some protection and could still be somewhat profitable, maybe not the full profit, but at least decent profit. But that big June section there really, of course, hurt. Well, this one here, let's just tell it what it is. This one here really hurt it at that time because it is a bullish strategy. Covered calls and naked puts there are bullish strategies. And I was surprised, though, when he had mentioned that to me in May that he was doing well. And then I looked at some of the results without further research and analysis that he might have been using. Earlier this week, I had a discussion with Steve L., one of our PowerOptions subscribers, and he was asking me questions about what do I think about buying calls or puts based on the candlesticks using SPX, SPY, QQQ, maybe even some stocks. And he's going to start doing this with a portion of his portfolio, maybe 10, maybe 15%. And he's looking to follow the candlesticks in the morning and the afternoon. Buy calls or buy puts, just 1 to 3 day trades, make a couple $100 bucks, and then close out the positions. Now, Steve's going to discuss this with me next week, so I'll have more details on that. But this is another approach that a PowerOptions customer is using. I'm not going to say it's similar to what I am doing with the ETFs, buying calls and puts on the ETFs and the different market conditions. But that's how I was doing it with the earnings season. You know, buying the puts on the XRT retail ETF after Target had its big loss, and then I was in the puts through the Abercrombie and Fitch decline and through some other retail stores decline. Oil and gas, of course, was bullish at that time in that case as well. So that was an approach that I was using to play around with changing tactics. And just this afternoon, we're going to have a follow-up on this in a minute. Not as much detail as I had time to get into, Bob, but we're going to discuss this a little bit. Bob says, as one of my income-generating strategies, I purchased long-term leaps on stocks, ETFs, and indexes, primarily SPX, which have both monthly and weekly options. I've typically sold weekly options against those positions and rolled them out to the Friday or the last trading day of the following week based on the ITM OTM probability, in my view, on the shorter term 1 to 2 week price direction of the underlying. He's doing primarily calendar call spreads, which is typically a bullish position. The poor man's covered call, buying a leap option that's in the money, a leap call option that's in the money, and selling at or out of the money near-term options against it, and just rolling that call as the market moves. I think the comment here that Bob mentioned is that following me based on their OTM probability and my view on the shorter term 1 to 2 week price direction. He might actually flip his calendar call from a bullish structure to a bearish if he's selling calls that are below the strike price of the call he bought with market declines to still try to hedge that price. That's more like a bear call credit spread with a calendar structure, where my sold call is below the bought strike price of my leap that's out to January or further out in time. I think he's just rolling around it. Of course, if you're bearish, what we talked about before, previous webinars, you can always look at the calendar put structure, buying an in-the-money put 5, 6, 8 months out in time or more, and selling out of the money near-term puts against it. Doesn't count as a naked put because you have the long put in place, so you don't have to put up the margin requirement. It's like a bear put debit spread, but different months to expiration. And Bob had a follow-up question to that, but we're not going to talk about that right now. So quick recap. And just say, normally, leading up to 2022, and you've heard me say this before, usually my portfolio is about 40 to 50%, maybe 50%, 55% in married put positions, following the rules in the blueprint, the radioactive trading techniques for protection on core holdings with the 12 different adjustments to generate income, lower the risk, and more. I've been looking at bearish collars more instead of standard collars also in that slight portion of that larger portion of my portfolio. I would usually have 15% of my portfolio in a bull put credit spreads, but when the market turned, that 10% started to go to calendar puts and bear put debit. I lightened the load. I lightened the exposure in those leveraged spread positions, but I switched to more bearish positions. 5 to 10% in those out of the money strangle positions. I was talking about buying an out of the money call, out of the money put a couple months out in time on SPY or QQQ, and rebracketing as the profits were realized on one side and the loss was realized on the other side as well. And then, of course, the earnings plays I mentioned on the ETFs and shares of volatility ETFs as an overall portfolio hedge. Now, Ernie wanted me to clarify something on this, not this directly, but earlier this week. Yes, I'm still doing married puts, and yes, married puts are a bullish strategy. I can medicate. It's not supposed to be medicate. I can alleviate some of the risk following the rules in the blueprint and the income methods in adverse markets and negative markets, but that structure does work best for bullish securities. You know, I have a Starbucks position that's just about the same price where it was when I bought it a few months ago, but I've managed to reduce the risk from 7% down to about 4% in 22, 25-day period. That's not too bad. It's like generating 2.5% of income in that 20-day period. A lot of coaching sessions, though, I've had are customers reviewing their married put positions in their PowerOptions portfolio, evaluating income methods. There's a fair amount that are doing those. We saw that in the poll with the protected positions. Chuck started us off, 99% in credit spreads, bull and bear, target 1% per day or 5% per week. Steve was looking for long call, buying calls and buying puts based on the candlestick charts, 1 to 3 day trades. I don't know what his targets are for the profit that he's going to take. I'll find more about that on later on. A couple months ago, Don asked us about, actually just 1 month ago, Don asked about the deep out of the money credit spread positions, maybe some of those neutral iron condors being 20% on the money on SPX, NDX, maybe IWM or the Russell 2000. And that was a 1 to 1.5% return for his risk tolerance and target goals for a 30 to 45 day time period. The spread we looked at was 35 days for 1.4%. The gentleman from May who was using the monthly naked puts and covered call, the picks of the day results, it was averaging 1% per month. It's below that now. We saw about that 4.7% return on the covered calls and the 3.8% return on the naked puts. So about 0.5% per month for the naked puts and about 0.75% per month average for the covered calls. Not great, but not a loss either. So that's something positive, but it's probably not hitting our targets. Bob was rolling diagonals against leaps. He's doing calendar calls, poor man covered calls on the indexes and ETFs as well. Now, for those of you that are here, you can let us know what you're using in the comments. here in the question pod. For those of you who are watching the recording, leave it on the comment on YouTube there. Tell us what you're doing. Of course, you can always send me an email to support@powerop.com. Following that up, Fernando was chiming in with us recently. He says, I am bearish. So I use with profit strategies composed by 3 bear OTM put spreads. So bearish OTM put spreads, bear put debit spreads, 40 days, financed by more OTM sold puts. That's right. You're doing that laddered structure, if I remember correctly, Fernando. We've got a couple more sold puts and the bought ones there, and it's sort of laddered down. If the stock doesn't move or goes up, you earn from the theta decay from the sold options. Absolutely. The stock goes down, I earn more from the bear put spreads. The down break even is very far, so I can use the money of the 3 verticals to finance more and more vertical during the following. I think we talked about this in a presentation, Fernando. I'll have to try to find where that is and post the link to that up here so someone can see the structure. You said the theta decay is higher on the lower delta options. What does he mean by that? He means the options that are further out of the money with the lower delta. It might be a lower premium, but that premium decays more rapidly percentage-wise than the at the money or out of the money. Not monetarily, but percentage-wise. He goes on to say, when that first bear put debit spread is triggered, I use that money to create a new bear put spread at lower strikes, similar to rolling the strangles and straddles I'd mentioned, or strangles really. Inflate the chain of the vertical and shift the structure to a lower break even. Now, Fernando adds that obviously this strategy with multiple sold puts on the position and having a spread in place, but you have other naked puts on the position. He says this strategy requires a margin account. Use a maximum 20% of allowed margin because when the stock goes down, the volatility is higher also, and the margin can grow. And that's something that's very important, Fernando, to point out, because as volatility shifts, some people have been getting margin calls on positions that were too exposed, that they didn't have the proper protection. I'm not saying you don't have the proper protection, Fernando, but it's always important to note that in a large volatility spike, your brokerage may see that as an additional exposure that you don't particularly need, and you may get a margin call or request to reduce the number of contracts or put up more monetary value there to cover the trade when a large spike occurs. All right, so disclaimer, of course, I have not verified the returns from investors who discussed their approach. Don's return I know because we did that in a webinar, but it wasn't a real trade. We went back a couple days in time, looked at what spread would have matched his desired goal of 20% out of the money for 30 to 45 days out. And we saw that position. We used the midpoint prices. No guarantee we would have got the midpoint prices at 35 cents. Options trading involves risk, as we know, may not be suitable for all investors. Always practice proper position sizing, regardless of what structure you're trading. Never risk more than you can afford. Always assume the worst case scenario. I'm not trying to be a Debbie Downer, but hey, you can expect a stock to do one thing, and if it does the exact opposite, were you too exposed? You've got a plan on that. As I mentioned, always have an exit strategy. Have alerts set and triggers for when the position starts moving against you for any investment strategy. Fully research all aspects of a strategy, the risks, the obligations. Remember, just because you're in a spread of a certain kind, ratio spread, ratio back spread, doesn't mean that it's totally removed all of the obligations and rights that come with the buying and selling of options. So make sure you're aware of all of that in the case of any risky early assignment or anything of that nature in uncertain trading markets. And again, as I mentioned, let me know in the comments. We heard from Fernando there what he was doing. I'll have to try to find that other webinar there where we showed sort of a structure in that trade. But at the same time, of course, let us know what you're doing. Let us know what's working for you or not working for you. Or if you watch this video in the recording and you saw the polls there, go through those polls and ask yourself what you've been doing. Try to re-verify with those polls and reacclimate yourself with what have I been doing? Where do I stand? What has been working? What hasn't been working?